Have you ever watched your portfolio look like a lottery ticket in the morning, and a mistake by lunchtime, then caught yourself wondering if you should sell right now before it gets worse? Imagine this. At 9 a.m., you feel unstoppable. Your brokerage account is glowing green. Coworkers are asking how you got so good at stocks, and you're already doing the math in your head. Freedom, upgrades, time. Then you check again at noon. The numbers don't dip, they lurch. By 3 p.m., the same screen that made you feel rich in the morning is now asking how much pain you can tolerate before you hit sell. That emotional whiplash, rich at breakfast, nauseous by dinner, has happened to millions of Americans across different decades, for different reasons, but with the same ending. The stock market doesn't just fall. Sometimes it snaps. And when it does, it teaches the same lesson over and over, just dressed in a new costume. It begins in 1929. The most famous gut punch in American financial history. On Black Tuesday, about $14 billion vanished in hours, roughly $230 billion in today's terms. The cause wasn't mysterious. The 1920s built a perfect storm of optimism, hype, and easy credit. Regular people could buy stocks with just 10% down, effectively renting wealth with borrowed money. Most weren't investing in businesses they understood. They were gambling on prices that only went up. Banks joined the frenzy, speculating with customer deposits. When reality arrived, the market didn't stumble, it collapsed, losing about 89% over 3 years. The charts don't show the worst damage. Banks failed. Families lost their life savings. 1 in 4 Americans couldn't find work, and soup kitchen lines stretched around city blocks. Even the so-called winners paid a price. Jesse Livermore made about $100 million betting against the crash, but after later losses, he took his own life. The market doesn't just destroy portfolios, it reshapes lives and distorts identities. America tried to recover, and by 1936, headlines declared victory. The market had doubled from its lows, Roosevelt was re-elected, and confidence returned. Then came 1937. The Federal Reserve, fearing inflation, doubled reserve requirements, choking credit. At the same time, government spending was cut, and taxes raised. It was like slamming the brakes while cutting the engine. The market fell about 49%. Manufacturing collapsed. Unemployment jumped from 14% to 19%. Workers who had just dared to hope lost everything again. The economy only truly recovered when war clouds gathered in Europe and military spending surged, proving that sometimes it takes a catastrophe to restart growth. In 1962, fear came from a different place. President Kennedy publicly attacked U.S. Steel over a price increase, shaking investor confidence. The market slid about 22%. Corporate scandals added fuel, and even blue-chip stocks fell hard. Quietly, Warren Buffett bought while others panicked, testing the philosophy he would later be famous for, being greedy when others are fearful. 1973 brought a crisis Americans could see and feel. Gas stations posted signs saying there was no fuel. OPEC cut supplies, oil prices jumped from $3 to $12 per barrel, inflation surged, and the market fell about 48%. The so-called one-decision stocks, the Nifty 50, were exposed. Polaroid lost about 91% of its value. Avon collapsed. Yet companies that adapted thrived. McDonald's introduced the Egg McMuffin as consumers tightened budgets, and its stock recovered far earlier than the broader market. In 1987, fear moved faster than humans. On October 19th, the Dow fell about 22.6% in a single day. There was no recession, no mass bank failure. Instead, computer-driven portfolio insurance triggered automatic selling, creating a feedback loop with no breaks. Liquidity vanished. Paul Tudor Jones, having studied past crashes, positioned for the fall and reportedly made about $100 million that day. Automation turned panic into a weapon. The late 1990s proved that market crashes don't need to start on Wall Street to shake the world. The Asian financial crisis began in Thailand when its currency collapsed almost overnight, exposing years of easy borrowing and fragile growth. Companies across Asia had taken on massive dollar-denominated debt while earning revenue in local currencies, a mismatch that became deadly once exchange rates broke. Indonesia's rupiah lost about 80% of its value in months, wiping out businesses and personal savings. In South Korea, the crisis became so severe that ordinary citizens lined up to donate gold jewelry to help the nation pay its debts. In the United States, the danger surfaced through long-term capital management, a hedge fund run by Nobel Prize-winning economists. Its highly leveraged bets unraveled so quickly that it lost about $4.6 billion, forcing the Federal Reserve to step in and coordinate a rescue to prevent a global financial chain reaction. Then came the dot-com bubble. In 1999, saying "we're an internet company" was enough to raise millions. Pets.com burned through cash and vanished. Webvan spent about $800 million before collapsing. When the bubble burst, the Nasdaq fell from over 5,000 to about 1,470, wiping out roughly $5 trillion. Even Amazon fell by about 93%. Warren Buffett was mocked for avoiding tech, but his refusal to invest in what he didn't understand allowed Berkshire Hathaway to outperform dramatically when the crash came. 2008 started with a simple lie. Housing prices never fall nationally. Banks gave loans to anyone, packaged them as safe investments, and spread the risk everywhere. When housing turned, everything broke. Lehman Brothers collapsed. The market lost over half its value. Retirees were wiped out. Employees were told to clear their desks overnight. Yet a few investors who saw the rot early, like Michael Burry, made fortunes betting against the system. In 2010, the flash crash showed how fragile modern markets had become. A massive sell order triggered algorithmic chaos. In minutes, the Dow dropped nearly 1,000 points. Stocks traded at absurd prices, and then rebounded. Nothing fundamental had changed. Years later, a lone trader operating from his parents' home was blamed for manipulating software, proving how vulnerable the system was to speed and structure. December 2018 reminded investors how quickly calm can vanish. The worst December since the Great Depression saw the S&P 500 fall nearly 20%. Rate hikes, trade fears, and a poorly timed reassurance from the Treasury Secretary spooked markets. The bottom came on Christmas Eve, followed by a rapid recovery. 2020 delivered the fastest crash ever. In weeks, stocks fell about 34% as COVID shut down the world. Oil prices went negative. Zoom became more valuable than entire airline industries. Then came an equally fast recovery, fueled by stimulus and digital transformation. Public panic and private profit collided as investors like Bill Ackman warned of disaster while positioning to benefit. Now 2025 sits uncomfortably close to the present. Markets have been shaken by tariff uncertainty, retaliation fears, and policy unpredictability. Investors don't fear bad news as much as unclear rules. When costs, supply chains, and earnings become impossible to forecast, markets punish uncertainty itself. Whether this becomes a correction or something deeper remains unknown. But history says the discomfort is familiar. Across every crash, the pattern is the same. You're buying a story about tomorrow. When that story breaks, you feel it instantly. Leverage magnifies pain. Confidence turns into denial. And the greatest risk isn't volatility itself, but how people behave under it. You survive by not being the ones who predict the future perfectly. They're the ones who prepare emotionally, respect risk, understand what they own, and stay disciplined when fear feels overwhelming. If history teaches anything, it's that crashes are inevitable, but financial ruin is optional. The market will always test patience, identity, and conviction. The goal isn't to avoid every downturn. It's to stay in the game long enough for compounding to matter. And when the next panic hits, the difference between regret and resilience will come down to what you decided before the fear arrived. If you want to understand the market beyond headlines and hype, this channel is for you. Here we break down crashes, bubbles, and booms, not as random chaos, but as repeating human patterns: fear, confidence, leverage, and denial, playing out across history. From 1929 to today, the names and triggers change, but the lessons don't. Subscribing means you'll learn how markets really behave, why smart people still panic, and how to think clearly when uncertainty is loudest. Not predictions, not hot tips, just clear thinking, historical perspective, and practical insight to help you stay calm, disciplined, and in the game when it matters most.